Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Circle.
If you find our talks useful, please consider subscribe, like, and comment underneath. So I want you to imagine a bank that pays like absolutely zero overhead for physical branches, right? No ATMs, no tellers. They just take your cash, earn a 5% yield on it from the government, and then keep all of that profit for themselves.
Yeah, which is basically the dream business model.
Right. It really is. And that is essentially the engine driving Circle right now. It's fueling this massive $25.7 billion valuation. And for you listening, I mean, this isn't just another tech or crypto play.
No, not at all.
This company is currently operating as, well, the premier public market proxy for the global adoption of digital dollars. So today we're looking under the hood at how institutional money is actively decoupling this stock from the rest of the sector.
We're also going to look at what the charts are signaling beneath a seemingly quiet surface, and of course those critical regulatory catalysts coming up in May.
Exactly. So let's just dive right into that $25 billion valuation. I think the best place to start is just breaking down the mechanics of the business model itself.
Right, because it relies on a very, very specific type of operating leverage.
Like a digital toll booth almost.
Yeah, like a toll booth, but even better. So the core product is a stablecoin. It's a digital token designed to always equal exactly $1, period. It doesn't fluctuate.
So if I hand you one physical dollar and you hand me one digital token worth exactly $1.
There's no margin there.
Right. There's literally no margin on that exchange. So the primary question for an equity investor is, like, how does a company drive massive stock growth from a product designed to never appreciate in value?
Exactly. And the profit mechanism, well, it's entirely about reserve management.
Okay, walk us through that.
So when an institution sends traditional cash to mint these digital tokens, that fiat currency doesn't just, sit idle in a digital vault somewhere doing nothing.
That would be a huge waste.
Huge waste. So the company takes those massive dollar reserves and deploys them into highly liquid, short-dated U.S. government obligations. We're talking mostly about short-term treasury bills.
Gotcha.
So the yield generated on those billions of dollars in government debt, that is the primary revenue stream.
And the volume of that reserve is expanding really aggressively right now. I mean, we are looking at their token supply being up 3.7% year-to-date in 2026.
Yeah, it's a solid start to the year.
And it's expanded by over 30% over the trailing 12 months, which is just wild growth.
It is wild. And that 7% expansion is where the operating leverage really kicks in. Because think about it, the physical cost to mint or redeem a digital token is, well, it's virtually zero.
Right. It's just software executing code.
Exactly. So when the reserve base grows by 30%, that scales their high-margin interest income almost directly to the bottom line.
Because they don't have to hire 30% more bank tellers or build 30% more buildings.
Right. There's no corresponding increase in operational costs. And this is crucial because even if front-end treasury yields begin to sort of soften globally, the sheer compounding volume of new digital dollars being minted easily offsets the lower yield per dollar.
Well, they make up in massive scale what they might lose if marginal yield drops happen.
Exactly. Scale is everything here.
That explains the revenue perfectly. But it also brings up the balance sheet. I mean, if they're holding billions in reserves, risk management has to be everything.
Oh, absolutely.
Because they aren't acting like a traditional fractional reserve bank, right? They aren't taking this cash and lending it out for 30-year mortgages or high-risk corporate loans.
No, definitely not. And that distinction, that's their structural fortress. They operate on a stripped one-to-one reserve backing.
So every digital dollar is backed by an actual physical dollar equivalent.
Exactly. The cash and short-term treasuries vastly exceed any corporate debt they have. The default risk is incredibly minimal because the underlying assets are essentially sovereign U.S. debt.
Okay, so the foundation is rock solid. But knowing all of this, the underlying technology itself is open source.
Right.
I mean, a competent developer could, code a stablecoin by tomorrow afternoon, couldn't they?
Yeah, pretty much. The encryption isn't a secret.
So what is actually stopping a massive wave of competitors from just mimicking this exact model and compressing the yield spreads to zero? What is their actual defensible moat?
Well, the technology is trivial, right? But the distribution is the moat.
Okay, unpack that.
Think of a global credit card network. Anyone can manufacture a piece of plastic with a magnetic stripe on it.
Sure.
But getting millions of merchants globally to actually integrate their payment terminals to accept your specific card, that takes decades.
Ah, I see.
Circle has aggressively embedded its digital dollars into the plumbing of the global financial ecosystem. First off, they have this deeply entrenched, exclusive economic reliance on Coinbase, which integrates their product globally.
Right, the Coinbase pipeline is huge.
It's massive. But maybe more importantly, they are really locking in institutional volume overseas.
The OSL Group partnership in Hong Kong is a perfect example of that, right?
It is a perfect example. Because what they're doing with OSL Group is integrating their stablecoin as a unified margin asset across OSL's entire global trading platform.
Meaning what, practically, for a trader?
Well, for an institutional trader in Asia, this means they don't have to constantly convert back and forth between local fiat currency and digital assets just to meet margin calls.
Oh, that saves so much time and money.
Exactly. The digital dollar just becomes the default settlement layer. And furthermore, they're launching tokenized money market funds.
USYC, right?
Yeah.
Walk us through the mechanics of that. Why does a tokenized money market fund create such a sticky ecosystem for an institution?
So normally, if a massive hedge fund or corporate treasury is operating in the digital asset space and they want to earn yield over the weekend, they have to completely off-ramp their capital back into the traditional banking system.
Which takes days.
It takes days to settle, and it incurs heavy fees. But by offering a tokenized money market fund, an institution can generate traditional yield within the digital ecosystem itself.
Wow.
Right. And once a corporate treasury integrates those specific software rails into their daily accounting and settlement operations, the switching costs become astronomically high.
Yeah, I mean, you don't rewrite your entire multi-billion-dollar settlement infrastructure just because some competitor offers a slightly cheaper token.
Exactly. It's way too much hassle.
Okay, so the fundamentals are printing cash.
Yeah.
And the distribution moat is incredibly deep. But knowing all that, you'd expect the stock to be tearing past all-time highs every single week.
You would think so.
But instead, it's just been consolidating. So what are the charts telling us that the underlying fundamentals aren't?
Well, if we look at the price action, the stock has been trapped in a fairly tight consolidation band since March 2026.
Yeah, we saw recent lows in the mid-90s, right?
Yeah, and currently it's hovering right around $106. That's as of April 20th. But beneath that sideways movement, the technical structure is actually setting up a classic bullish reversal, specifically an inverted head and shoulders pattern.
Okay, for listeners who don't spend their days staring at technical charts, explain the psychology behind that specific pattern.
Yeah.
Like, why does an inverted head and shoulders actually signal a breakout?
So it's essentially a visual map of seller exhaustion.
Okay.
The market pushes the price down to a low point, that's the first shoulder. Then buyers step in, pushing it up slightly. Then a wave of panic or heavy selling forces it to a deeper low.
That deeper low is the head.
Right, the head.
Mm-mm.
But the critical part is what happens next. The buyers push it back up, and when the sellers try to force it down a third time, they fail to reach that previous deep low.
So they just run out of volume.
They completely run out of volume.
Oh.
That higher low forms the second shoulder. It tells the market that the downward momentum is entirely depleted, and buyers are now willing to pay higher prices to accumulate shares.
And it is also sitting above its 100-day exponential moving average, isn't it?
It is, which acts as a dynamic floor, because an exponential moving average, or EMA, gives more weight to recent price action than older data.
Right.
So holding above that 100-day line means the medium-term institutional memory of this stock is still highly supportive. And actually, if we apply Elliott wave theory to this current consolidation, technical analysts place the stock squarely in the second phase.
Let's break down those phases, because the second phase is typically the frustrating part for retail investors, isn't it?
Very much so. Yeah, in Elliott wave theory, markets move in these predictable psychological cycles. The first phase is the initial burst of optimism and buying.
Everything goes up, everyone is happy.
Everyone's a genius, right? The second phase, which is where we are now, is the corrective pullback. It's shallow, it's sideways, and it's designed to shake out impatient capital.
Just grinding people down.
Yeah, just grinding sideways. But mechanically, it acts like a coiled spring. It's the necessary breathing room that sets the stage for the third phase. And the third phase is almost always the longest, most aggressive impulse wave upward.
The momentum indicators seem to align with that coil, too. I mean, the relative strength index, the RSI, is holding firmly above 50.
Yeah, and RSI measures the speed and magnitude of recent price changes to evaluate, overvalued or undervalued condition.
Right.
So a reading above 50 during a sideways consolidation is incredibly telling. It means that even though the price isn't exploding upward yet, the underlying buying pressure remains stronger than the selling pressure.
And add to that the super trend indicator, which measures volatility against price direction. It is on the absolute cusp of flashing a green buy signal.
Yep, it's all lining up.
But I want to push back on the broader market action here because there is a glaring divergence in the data.
Okay, let's hear it.
This stock is up roughly 30% year-to-date in 2026. But Coinbase, which we just established as their primary distribution pipeline, is actually down about 10% year-to-date.
It's true.
So wait, if the two companies are so economically intertwined, why is institutional money aggressively buying Circle while actively selling off Coinbase?
That divergence is actually the key to understanding the current market psychology right now. What you're seeing is sophisticated capital intentionally separating the steady growth of digital dollars from the volatile business of cryptocurrency exchanges.
Okay, what do you mean by that?
Institutions are targeting what is known as pure play stablecoin beta.
Meaning they want the compounding interest of the reserve model, but they want absolutely nothing to do with retail trading volume.
Precisely. A platform like Coinbase relies heavily on retail trading fees. If the broader digital asset market is moving sideways and retail traders sort of lose interest, transaction volume plummets and Coinbase's revenue takes a massive hit.
But Circle's revenue model doesn't really care if you actively trade their stablecoin.
Exactly. They don't care at all. As long as the digital dollars are minted and circulating in the global economy, the underlying treasury reserves are quietly generating a 5% yield 24 hours a day.
So smart money recognizes that decoupling.
Yeah.
They are rotating out of the transaction-heavy volatility of the exchange and into the structural compounding of the reserve model.
That's exactly it.
Let's look at the broader macro winds driving this sentiment too, because we did see a moment of severe volatility recently.
Definitely.
Shares across this entire sector took a sharp hit when hostilities flared up in the Middle East. But then they rallied back really aggressively after President Trump extended a ceasefire with Iran.
Right.
Looking purely at the mechanics of capital flows, as a market driver, how did that event dictate the price action here? We're just looking at it impartially, obviously.
Yeah, looking purely at the mechanics, it was a textbook demonstration of risk-off versus risk-on capital behavior. Well, when geopolitical tensions escalate to the point of, say, threatening global supply chains or energy markets, institutional algorithms automatically trigger a risk-off environment.
So they just sell everything risky.
Right. Capital aggressively flees anything perceived as a growth or speculative asset, retreating into safe havens like gold or the US dollar itself.
But the underlying fundamentals of the companies don't actually change in that 48-hour window.
Not at all. The company is exactly the same, but the capital environment completely shifts. The moment the ceasefire extension was confirmed, that specific left-tail risk evaporated.
So the market was allowed to just stop pricing in a worst-case macro scenario.
Exactly. And capital immediately flowed back into assets with strong structural fundamentals, which totally reversed the initial drop.
That makes sense. The market paused its thesis to deal with a macro threat.
Yeah.
And then just resumed once the threat cleared.
Yeah.
But speaking of shifting capital, there is a headline making the rounds that requires some context. ARK Invest, led by Cathie Wood, recently trimmed their position in this stock.
Yeah.
When retail investors see one of the most prominent, vocal bulls in the innovation space selling shares, the immediate reaction is panic.
Of course it is.
So should everyday investors be reading this as a loss of faith in the company? Or is it something else?
It's a natural reaction to panic, but it misunderstands how actively managed ETFs function mechanically.
Okay. Explain the mechanics.
ARK Invest isn't managing a buy-and-hold forever portfolio. They manage highly concentrated ETFs with very strict internal mandates.
Oh, so they have rules they have to follow.
Right. If a stock experiences a massive run-up, like a 30% year-to-date gain, it rapidly expands its weight within the overall fund. To maintain their target risk profiles and comply with their own fund rules, portfolio managers are mechanically forced to trim their winners.
So they sell off a portion of the high-performing stock just to reallocate capital into other positions within the fund that might be, like, temporarily undervalued.
Exactly. It's disciplined risk management and active rebalancing. It is not a fundamental abandonment of the thesis.
Especially when you contrast that mechanical trimming with the massive expansion narrative the company is currently telegraphing right now.
Right.
Jeremy Allaire, the CEO, recently highlighted a tremendous opportunity for a yuan-backed stablecoin.
And the total addressable market for that concept is just staggering.
It really is.
Right now, cross-border commerce in Asia is bogged down by legacy banking delays, crazy currency conversion fees, and totally fragmented regulatory environments.
It's a mess.
It is. A compliant digital version of the yuan operating on the same frictionless rails as their digital dollar transforms this company from a purely US-centric operation into the absolute base layer of global multipolar settlement infrastructure.
Wow, it completely alters the scale of their potential reserve base.
Exponentially.
I love the global upside, but it's time to stress test this thesis. We have to look at the bear case and unpack the legitimate risks that could, derail this entirely.
Always have to look at the downside.
Let's start with the Coinbase dependency. It's like owning a massive, wildly popular retail brand. But Walmart is your only distributor.
That's a good analogy.
Right. If Walmart decides to push their own store brand product to the front of the shelf, your revenue collapses. Doesn't Coinbase essentially hold all the leverage here by keeping the interest generated on the digital dollars held within its own platform?
Yeah, that is arguably the single largest vulnerability in the bull thesis right now.
Because of how the revenue is shared.
Exactly. The current economic sharing agreement heavily favors the exchange when those assets remain siloed on their platform. And Coinbase operates its own proprietary settlement network called Base.
Right.
If Coinbase management wakes up tomorrow and decides to aggressively prioritize Base over other rails, or, alters the liquidity incentives to capture more of the spread, it could severely compress Circle's share of the underlying economics.
So the distribution partnership is vital, but the dependency is a massive risk.
Huge risk.
And then there is the threat of the legacy financial system waking up. Right now, regulatory uncertainty basically keeps the massive traditional banks largely on the sidelines.
For now, yeah.
But if federal rules clear up, what is stopping a behemoth like JP Morgan or Bank of America from just issuing its own regulated dollar token?
Well, nothing, theoretically.
Right. They have balance sheets and political capital that make this company look tiny. Wouldn't the traditional banking sector just absorb this market and compress the yield spreads to zero?
If the competitive landscape shifts from software innovation to sheer balance sheet dominance, legacy banks absolutely hold the clear advantage.
Okay, so that's terrifying for the stock.
It would be, however, this company is not static. They're executing a strategic pivot to front-run both of these exact risks.
Okay, walk us through that defense. How do they survive?
First, regarding the Coinbase dependency. That OSL partnership in Hong Kong is a deliberate strategy to diversify their distribution pipeline.
Okay, so building out away from the Walmart in our analogy.
Exactly. They are aggressively building new highways so they aren't completely reliant on a single toll operator.
That makes sense. And what about the banks?
Secondly, countering the traditional banks comes down to agility. Legacy banking infrastructure is notoriously siloed and slow. I mean, it takes a traditional bank 5 years of risk committees, compliance reviews, and pilot programs just to launch a simple digital feature.
That's very true.
In contrast, this company has built out the Arc blockchain and fostered an entrenched open source ecosystem of thousands of independent developers.
So they're moving way faster.
Way faster. By the time a traditional bank finalizes the paperwork to launch a competing token, this company's infrastructure is already hard-coded into thousands of decentralized applications and payment gateways globally. They are relying on velocity to outpace the incumbent.
Okay, so bringing this all together, the mechanics, the charts, the macro flows, and the risks, we need a cohesive timeline for you listening. We are looking at a critical 3-month window right now. What are the key catalysts we need to be watching?
The immediate data point is their Q1 earnings report, arriving mid to late May 2026.
Okay, so very soon.
Right. The entire market will be dissecting their balance sheet to confirm that the 30% expansion in token supply actually translated to bottom-line profitability, despite any minor fluctuations in treasury yields.
But there's a bigger catalyst, too, right?
Yeah. The true sector-defining catalyst is political. The Senate Banking Committee markup of the Clarity Act has been officially scheduled for May 2026.
We need to unpack exactly why the Clarity Act is so critical, because this isn't just about, standardizing definitions for tax purposes. A favorable markup here fundamentally changes how institutional capital is legally allowed to behave.
It changes everything for a corporate treasurer.
Give us an example.
Imagine you run a multi-billion-dollar pension fund. You see the 5% yield generated by these stablecoin reserves, and you naturally want to allocate capital.
Because it's a great return.
Right. But your internal compliance officer looks at the current legal framework and says no, because the asset class isn't formally defined under federal banking rules. The risk of future litigation is just too high.
So they sit on their hands.
Exactly. The Clarity Act establishes those formal federal rules of the road regarding stablecoin yields.
Oh, I see.
The moment that act is marked up favorably, it provides the legal cover for compliance departments to finally approve those allocations. It unlocks billions of dollars of trapped institutional capital currently sitting on the sidelines.
So weighing the fundamentals, the technical setup, and the pending legislation in May, what is the final synthesis here for the stock?
Well, based on the structural strength of the reserve model and the impending regulatory unlock, this stock earns an 8 out of 10 bullish score.
Okay, 8 out of 10.
It is definitively positioned as a medium-term hold for a 3 to 6 month horizon, specifically to capture that May catalyst window.
And what are the price targets we should be looking at?
If we look at the technical roadmap, the next major upside target relies on the 50% Fibonacci retracement level, which sits at $175.
And the psychology behind a 50% retracement is essentially the market just breathing naturally, right? Assets rarely move in a straight vertical line forever.
Exactly. When an asset experiences a massive historic run, it eventually exhausts its momentum. Sellers take profits, and the price pulls back.
Makes sense.
Market psychology dictates that a healthy asset will often pull back to roughly half of its previous major move, that's the 50% retracement, before finding strong fundamental support and bouncing higher.
So hitting that $175 mark proves the structural floor is solid.
Right. And if the execution surrounding the Clarity Act is flawless, there is a very realistic longer-term potential to revisit the all-time high of $300.
Man, $300. Before we wrap up, I want to leave you with a really speculative long-term catalyst that is starting to gain traction in the deeper technical circles right now.
Oh, I love these.
We have spent this entire conversation talking about human institutions, right? Banks, hedge funds, retail traders, all using these digital tokens. But what happens when artificial intelligence enters the chat?
That changes the game.
There's a framework developing right now called agentic shopping. Imagine AI agents that are granted the autonomy to execute commerce directly on the internet.
Oh, wow.
Your personal AI assistant realizes you are out of groceries, negotiates the best price across 20 different vendors in milliseconds, and executes the purchase for you.
That's incredible.
But an AI doesn't walk into a Chase branch to open a checking account, and it doesn't swipe a physical Visa card.
No, of course not.
AI natively operates on code. It requires programmable money. It will use stablecoins.
It has to.
So if AI agents eventually become the primary executors of daily global microtransactions, processing millions of automated purchases a second.
The volume would be unimaginable.
Exactly. How exponentially does that multiply the demand for digital dollars? And subsequently, how massive does that underlying treasury reserve and the yield it generates become in the decades to follow?
It's a fascinating horizon to consider.
It really is. Thanks for joining us on Smart Wealth with Joshua. Don't forget to subscribe, like, and comment below.